In addition, the Fed greatly increased the size of its balance sheet and changed the composition of its balance sheet, substituting less liquid long-term assets, such as securities backed by mortgages from Fannie Mae and Freddie Mac, for the short-term Treasury securities that it typically held before the crisis. These policies have veered toward deciding how public money should be allocated across firms and across sectors of the economy. I believe that the government must intervene in allocating credit in this manner. Such decisions properly belong to the fiscal authorities, not to the central bank. By making these unprecedented lending decisions, and at times being a little less transparent than we could have been, the Fed has opened itself up to criticism from various sources, and has encouraged the idea that monetary policy decisions may be influenced by political or other special interests. This is truly not a healthy development. To promote a clearer distinction between monetary policy and fiscal policy, and to help safeguard the Fed's independence, I advocate that we implement monetary policy using a portfolio that contains only Treasury securities, preferably Treasury securities that are denominated predominantly in bills and short-term coupon bonds. Like Ulysses and the Sirens, the Fed could help preserve its independence by limiting the scope of its ability to engage in activities that blur that boundary between monetary and fiscal policy. Thus, I believe as economic recovery gains strength, my monetary policy begins to normalize, I would favor our beginning to sell some of the agency-backed securities from our portfolio rather than relying only on redemptions of these assets. I believe doing so would help extricate the Fed from the realm of fiscal policy and currently, in its particular, housing finance. From my perspective, explicit subsidies for housing finance should be in the realm of fiscal policy decisions. Now, it will take some time for the Fed's portfolio to return to pre-crisis composition, but we should begin taking those steps in that direction sooner rather than later. I also believe that the Fed's 13.3 lending authority should be either eliminated or severely curtailed. Such lending should be done by the fiscal authorities, and done so only in emergencies, and if the Fed is involved, only upon written request from the fiscal authorities, namely the Treasury. In such case, any non-Treasury securities or collateral acquired by the Fed under such lending should be promptly swapped for Treasury securities so that it is clear that the responsibility and accountability for such lending rests explicitly with the fiscal authorities, not with the Federal Reserve. To codify this arrangement, I believe we should establish a new Fed Treasury Accord, a step that I began to publicly advocate over a year ago. This would eliminate the ability of the Fed to engage in, quote, bailouts of individual firms or sectors, and place much of the responsibility with Treasury and Congress squarely where it belongs. Finally, I think we must work harder to enhance and improve the transparency of the Federal Reserve. We have come a long way in the last 20 years, but some of the actions I just mentioned, adopting a Treasuries-only policy and eliminating or vastly curtailing 13.3 authority through a new Fed Treasury Accord, can help restore the public's confidence and trust in the institution and help preserve our own independence to conduct sound monetary policy on behalf of the entire nation. In closing, nearly a century ago, there were valid reasons for creating an independent and decentralized central banking system. I believe those reasons remain valid today. Upsetting the current structure's checks and balances puts at risk the Fed's ability to deliver on the monetary policy goals set for it by Congress: price stability and maximum employment. Recent proposals that remove the GAO exemption for monetary policy would politicize the decision-making and risk sowing the seeds of higher inflation and greater economic instability. Making Reserve Bank presidents and chairs of their boards political appointees would also reduce the checks and balances between the public and the private sectors, and weaken an important source of independent voices from the Federal Reserve System and limit the input of Main Street views. The independence of the Fed or any central bank does not guarantee, though, that all choices they make will be wise or perfect, particularly in hindsight. I will be the first to acknowledge, and during much of my academic career, frequently pointed out that the Fed has made its share of mistakes, and no doubt will make mistakes in the future. The great inflation of the 1970s is a perfect example. Indeed, the cause of the great inflation stems directly from political pressures on the Fed to help finance the Vietnam War with the creation of money, which it did. Pressure to provide excessive and prolonged policy accommodations in the face of the oil shocks of the 1970s, which it did. Thus, the great inflation, from my point of view, was a failure by the Fed to exercise the independence it had to resist the political pressure. Not one of our prouder moments. Yet economic theory and the historical record suggest that turning monetary policy, and thus the printing of money, over to the fiscal authorities or the political process could be much worse. Indeed, I would ask those who think the Fed kept interest rates too low for too long in the early part of this decade, and thus perhaps feeding the crisis that we see today, to imagine the outcome had that process been more politicized. I doubt that that would have led to interest rates rising faster or sooner. In fact, it's probably likely that in that environment, rates would have been kept lower for longer. Strict limits on outright prohibition of the Feds to engage in 13.3 lending under a new Fed Treasury Accord, I think would help restore some explicit separation between monetary and fiscal policy and help preserve the Fed's independence and the public's trust. And retaining our portfolio to all treasuries and committing to traders-only policy would reduce the pressures on the Fed to use its balance sheet to engage in fiscal actions. In the aftermath of this financial crisis and large fiscal deficits, the Fed still faces significant challenges. I believe that we can exit from the extraordinary stimulus we provided without generating severe risks to inflation in the intermediate to longer term. But doing so will require some very careful and difficult policy choices. Monetary policy makers must have the courage and the independence to make those difficult choices. Politicizing that decision-making process will not deliver the desired outcomes and runs counter to sound and responsible practices in central banking. Thank you very much.